everyone for this session. Thank you for your interest, for the microphone. Yes, thank you for your interest. We can see many people which would like to stop growing and to start scale. So this is quite impressive. My name is Peter. I'm the head of entrepreneurship of the Swiss Entrepreneurs Foundation, and I'm the responsible person for the upscale program. We only have 45 minutes for a big topic, so this will be a kind of a sprint. Let's get started right away. As you can see on the agenda, we will start with Peter Balsiger, which will explain the difference between scaling and growing. And then we do have two interesting case studies. One is Spexio and the other one is Hitzberger. And then in the last part, you will have the opportunity to ask questions. The session will be presented by seasoned entrepreneurs. They are all serial founders and investors, so you have to grill them during the question session because normally they do grill the startups in our program as experts. But before we will start, I would like to give you a short overview about our upscaler program. It's quite a unique program for those startups who would like to scale. So if your company has at least 0.5 million in annual revenue, 10 employees, 20% annual growth, and a business plan for the international expansion, then you are ready to apply. We will give you at the end of the session more information and the QR code where you can grab all the details. The program offers a lot of benefits. So we do a light due diligences. We have, you will have, if you can apply, you will have 2 years of access to our network with 50 experts. You will get 80K barter credit for workshops. And of course, we are also helping to connect you with the right investors. So we are backed and by really famous people. So it was our foundation was initiated by the federal councillors, Johann Schneider-Ammann and Guy Parmelin. And we do have a collaboration with Deep Tech Nation Switzerland since 6 months, 5 months, 6 months. The CEO, John, is sitting here in the room. And the president of the foundation is the CEO of Swisscom, Christoph Eschlimann. So only some remarks about our track records. The upscaler has been running for 5 years now, and as you can see, we do have quite a good track record. 50% of the startups in our program have doubled their revenue during the participation, and that's the most important thing for us because we are really eager to create impact. That's only a bit of information, so let's start with the more interesting part of our session here. I can hand over to Peter Balsiger, as I mentioned, a serial founder and very well-known and renewed expert. And he will start to explain you the difference between scaling and growing. Peter, the floor is yours.
Thank you, Peter. So in a nutshell, you do have costs in a company and you would like to master the development during your growth phase. Also, the art, we can call it an art, is to have a revenue growth, but a cost growth that is not proportional. That means the difference here is the difference of the profit of the company. So you have to develop a go-to-market strategy and assign it costs that do offer you this slower increase in cost when you do have an increase in revenue. So how to act on these parameters? The parameters are mostly driven by fixed costs. This is almost a linear thing. That means G&A. We have other costs like R&D when you want to develop further your products. You do have the cost of goods sold. That is the manufacturing of your products or the data storage costs when you have an online business or an online store and so on. And you do have the sales cost. The going to market strategy is dominating exactly this difference. When you do that smart by automating as much as possible your sales processes, the other processes in your company, you do get this type of behavior. So what we have done during these workshops, we have been analyzing the companies, we have been doing due diligence light and the model, and we have been looking for figuring out how to tune these costs and the business model that you get this behavior. So the efficiency is especially well shown in SaaS models. That means recurring revenue models. Recurring revenue models do have one big advantage. You have once a customer acquisition cost, this famous CAC. This CAC you have once, and then you have a recurring customer. And what is the cost assigned is customer support, to maintain him, to become a loyal customer, staying many, many years with you, paying you this abo costs and all these recurring costs. And you do have, in addition, that is an additional booster of the exponential revenue, upselling potential. You have already onboarded your customer, and you have the potential, you know this customer well through the customer support. You can propose him additional products or additional abos or additional features in order to increase the basket value when you do online DSUT, direct to customer models, or you do have the potential to have a lifetime value of this customer that is much longer. So what is important that you understand also this point here, this is the cash flow break-even point. For your investors, for your shareholders, and we have seen pre-COVID, COVID, and after COVID, this break point investors want to see is as early as possible in order that your company is not burning all the time cash. So that is very important to be attractive for investors, that you have to master this break-even point as early as possible, and then afterwards to have a profitability that is growing, not proportional to the costs, but it is an exponential difference. Let's now look a little bit at the normal growth case. What we have also to say, many young companies go first to a growth phase. Later on, they are capable to switch that business model into a scalable business model. And that's exactly what we have seen in the workshops, in these 500 workshops. You can tune a business model. When you start with the growth potential here, you start to burn money. This is the burning phase. That's where your investor need to believe you come to this break-even point in a substantial, reasonable time. And that is for they give you a valuation when they buy your shares. So when you miss this point, you disappoint your investors, you will have a problem because you need more and more and more investments into run that type of business model. Let's now compare these two business models. These two business models, first of all, when you do it smart and you automate as early as possible, you master the costs in all elements in your company, you have a better chance to go to this break-even point. And this break-even point gives the loyalty to your investor because you don't disappoint them. And you disappoint your employees, you disappoint yourself. So master costs from beginning. Design for cost when you manufacture products. When you do a kind of SaaS software business model, look at the beginning at good conditions to store data and also license other softwares, because this point will be influenced. And you see the investments. In this type of business models, you have a sequence of financing rounds to cover the burning phase. In this type of business models, you have maybe initial investments to develop the platform, and then afterwards you have maybe a second investment, but it doesn't follow anymore after the break point here in this session there. So for investors, now let's look what is now for the evaluation important. How do you get money to run your business? So from a revenue perspective, you have a high growth in the scale model and you have improved margins. That's anyway very interesting for the investors. They are looking for this type of revenue streams. When you look at the cost structure, you do have a much slower growth of your costs that also investors are looking deeply in, because when you want to just go abroad to other countries, you have to open subsidiaries, you have to hire people there in an untapped market where you have no clue. For investors, this sounds not very compelling because it's risky. So let's look at business models where this don't happen. When you look at the profitability, these business cases are mostly very profitable. They reached 30–40% EBITDA margins in scale models. Here, you will be between 15 or 25% mostly in this type of business models. So the multiples here are much more interesting for you as a founder and for your seed investors, because you get much higher multiples, much higher valuation for this type of business models. It's also something very important. The predictable cash flow in recurring business models where a customer is paying recurringly his fees gives a stability on the top line. You have much less fluctuations and volatility on the top line. This is something investors do really like, to have a predictable revenue forecast. And then you have to do the churn. In a churn, to have a churn, that means you lose customer on the way. So you have to work to keep them alive, to keep them interested into your company. Churn is an important drawback when this starts to raise. It's a kind of oscilloscope giving you an indication if the business model is stable in the market. So we have listed you a number. Maybe you can take a photo of that. We don't have the time to deep more into details. We have listed you 8 points you have to look at in order to drill down a scalable business model. I guess, Peter, it's possible that people can even download the presentation later? Okay. So now let's talk with Jeremias, one of the very interesting cases, successful cases from Switzerland that has proven that we are capable in Switzerland to do that.
Thank you, Peter, very much. We will come back to you with questions. So let's move on to the first case study, Bexio, a very well-known SaaS platform for accounting. And thank you for being here. We are eager to learn more about your experience in scaling such a crucial business for startups.
Thanks a lot. Thanks for having me. I guess some of you might know Bexio. Bexio is the leading cloud-based business and accounting software for SMEs in Switzerland. Bexio serves like the S of the SMEs, so like the really small businesses. This is probably also why a lot of early-stage startups start with Bexio. We founded the company in 2013. Already started to experiment with the products a couple years before, so it wasn't an overnight success. And in 2018, the company got acquired by Mobiliar, and today Bexio is the market leader in its segment and serving 90,000 customers in Switzerland. Probably a market share of 25%. So quite a big company today. And I was looking at some data points to show you how Bexio did scale, and I came up with this chart, like showing like customers per FTE. So when we started, of course we had like maybe 3 or 4 customers per FTE, but like after 2 years later, we were about roughly 70 customers per FTE, and today Bexio is at 350 customers per FTE. So like this is a nice example where you see like the costs are like stable and like the revenue is still growing at above 30% per year right now. So, but in the beginning, you start with stuff that don't scale, obviously. So it's not about building a scalable business from the beginning. But of course, it's a big advantage if you start with a scalable business model. We heard it before from Peter. Software as a service, it's a subscription-based business model. Of course, it's scalable if you have like a solid cost base. And like you have low marginal costs, or in other words, you have a very high gross margin. Like the only costs you have to serve clients are like the servers, the software runs on it, and like customer success and customer support. That's pretty much it. So a software as a service company has typically about 80% gross margin. So this leads, but be careful, like you need a high retention. This means if your customers aren't happy with your software, they're going to churn, they're going to cancel their subscription, and you have wasted all the customer acquisition costs to win them. But if you have a high retention, you will have like superior unit economics, meaning you have like high customer lifetime values. Take the example of Bexio, like a Bexio subscription costs 50 Swiss francs a month. That's not much. And acquiring a Bexio customer costs, I would guess, I don't know the actual numbers right now, but like a couple of hundred Swiss francs. So this means you'll need to retain these customers for at least a year, like only to pay back the customer acquisition costs. So this is what you really need to be aware if you build such a model. And to get there, you really need to start with things that don't scale. You really need to have a deep understanding of your customer. You need to understand how they use your product, how you solve them a problem or not. But if you get there that you have like a very high retention, you can invest even more in customer acquisition. And then it comes like, it's just about automation in sales. It's about building a data-driven model and also data-driven culture to really, because like it's a huge marketing story, but we were always talking about numbers. It's all about numbers. It's not about good ideas. It's about measuring what works and what not. So being very data-driven in the go-to-market is essential if you want to scale rapidly. And once you've built the machine, so you see like, okay, we have like unit economics, we can retain the customers, meaning we probably also have like a certain degree of product market fit. Then it's about access to funding to really fuel this machine. Because like what's also typical for such a model is like, the faster you grow, the faster you burn money. Because like you're selling subscriptions, and if I win a customer, he starts paying me 50 francs a month, but I invest 500 to get the customer. And if I do that 1,000 or 2,000 times a month, you could imagine how my cash flow looks like. So this is why this type of model really needs a lot of funding. And of course, then market timing in the case of Bexio was also like quite a success factor. But what I would recommend is really start with things that don't scale. I often meet founders, they are already trying to build a scalable model, but they don't have product market fit. So in the beginning, I'm right now building a new company, and I'm not thinking about scaling. I'm obsessed about spending time with customers to learn how they use my product, to learn what pains they have, to learn how I have to message them, how do I pitch my product to them. And this is why my sales process right now is not automated, is not efficient, it's not scalable at all. Because like I'm able to do maybe 4 or 5 meetings a day, so this won't get me to big revenue numbers, right? But it helps me a lot to understand how I will build the scalable model once I've reached product market fit. I think that's very important. So, example from the Bexio time, once a year, I was for a week, I was visiting customers. So me and my team, we sat in a car and we drove around Switzerland and we met them, we brought them presents and we want them to show us how they use our product. And I remember an investor said to me, you know, this company is paying you 400 francs a year for the subscription. This money is gone if you sit in a car and you bring them presents if they're in Geneva. I said, yes, but they're going to learn a lot and this will help me to acquire the next 1,000 or 10,000 customers. So start with things and don't scale. Be obsessed about data, measure everything from the beginning to really understand when you hit the inflection point, when is the right moment to really invest heavily into scaling and to leave like the early stage mode. And of course, sales matter. Like, do not fall in love with your product. Your customers have to fall in love with your product. So this is also why at Paymira right now, I started doing sales before I have a product. Because like this is the only way I can really find out if I'm solving a relevant problem. Because like everyone tells me, it's a nice idea, it's so cool. But if I want someone to buy it, to put money on the table, that's a completely other story. So don't forget to start early enough with sales. So these were like my main learnings from the Bexio stories. Thanks a lot. And we might have time for questions later or
yes.
Later. Okay, great.
Thank you very much, Jeremias. Sharing your learnings with us. And now the second case study is Hitzberger, very well known for healthy fast food. And the only man who knows the secret how to scale a fast food chain is here. It's Andy, please.
Thank you, Peter. Thanks for having me. Food is bricks and mortar at the end. And so that's totally something different that we learned before. So I'm happy to share some insight from my story. So Hitzberger in a nutshell, that was actually our vision was on the first pitch deck. And I still like it actually. But it describes really good what we did. So we founded in 2009. There was fast food equal to junk food. And we had the mission to make it healthy. We realized very early that we have to build a chain in order to be profitable at the end. So we have to take all the scaling, the benefits of scaling. At the end, when I left Hitzberger, we had 12 points of sales in Zürich, Bern, and Basel, around about 120 employees. So that's also a big difference to Bexio. I mean, you have people that are doing the food freshly. You have people that sell it, and this in several cities. So it takes some FTEs to do that. At the end, we had double-digit million revenues, and we had the exit of 8 years after founding in 2017 to Migros. I'm still very happy that Hitzberger exists in the Migros world. When we see what happens there, it started with actually with the Glattzentrum when they sold it, and now with Do It and all these Mikasa and all that stuff. So I'm very happy that Hitzberger exists, and that's not for granted. So I'm very grateful actually to the buyer that they still believe in the concept. So if you look at, we had the customers at Bexio, we talk about guests in gastronomy. So I think the main thing is that you have a headquarter that is quite lean. And when you add new locations, that the costs of the headquarter doesn't grow in the same way. One thing is, when you remember what Peter at the beginning said, that okay, you have probably 2 financing rounds and then that's it, or you have to invest 2 times and then you're profitable and then everything is gone. In gastronomy, that's not the case. It's not possible. Because each location, this one is the one of Bern, costs about 500K or 1 million Swiss francs just to build it out. Furniture, air conditioning, all that stuff, the kitchen. It's quite expensive. So in order to grow as a chain, you really need also afterwards some money. So what were the key success factors? I identified in retrospective that a solid financing is very, very helpful. Because what I realized is that everything you do takes double the time you thought and costs 2 times as you had it in your business plan. And given the keyword business plan, we did it quite seriously. And we found out that we just don't raise for 1 million at the beginning. We showed up the first round investors already that we'll need more money. And so we kept also the first round investor to the second round, to the third round. So we had enough money actually to scale. Then there's a BOMO actually in retail and gastronomy, which are the 3 most important key success factors of retail and gastronomy. The first one is, it stands here, location. And the second one?
Location.
Exactly. So it's a BOMO, so it's already known. It's third, and also the third one is location. And that's really, we learned it the hard way. When we remember the picture of the affiliate in Bern, we had to close it down, to shut it down after 2 years. And we spent around about 1 million. We invested around about 1 million to build it up. It's quite hard actually to have a good location, to get it. At that time you need it. And that's one of the main things. So at the end, when you look now at Hitzberg, it's at the train stations, it's the main station in Zurich, and these are the kind of locations that are very important for such a chain. Then in gastronomy especially, one of the key success factors is you can't just stay with your products. I mean, McDonald's has also his favorites, and you can't change them every time. But even they have the Swiss special, they have the McRaclette or whatever they call it, and you need to be aware of the trends and to introduce them. I mean, when we started, vegan wasn't very well known. We just started with meat and vegetarian alternatives, but then quite early, we got called up by vegans, and they told us, "Hey, why aren't you vegan?" And we just thought, are these kind of people just loud, or are these many people? And we decided to go for the second, and we were right. So we just started very early with vegan options, and it became a trend actually, and still is today. So that's also one thing you have to innovate, otherwise you will disappear from the market. Some of the do's and don'ts, I think every founder here can say that team, people is key. I'm glad that I knew my co-founders already before I started the company. I mean, in good times, it can get some tensions. I mean, if it goes to an exit, then these are the good times, but also then you have probably different views on it. But also then in the worst case, I mean, then you really have to have the right co-founders. But it also for your team. I just realized that we got applications, Hotelfachschule, whatever, and he or she was working in that beautiful company. But at the end, I just learned that I will go for the character of the employee, because the other things, the qualifications, you can give them afterwards. And one example actually where we didn't scale, we just in contrary to the theory we got, is the food truck example. Already in 2011, we had our Hitzberger Mobile, we called it, and we were thinking about just building up 10 of them, because you can't buy them as they are, so you have to buy a car and then you have to rebuild it after your needs. And so we thought about, okay, let's build just 10, then the costs per unit go down. But we realized, okay, it's quite early for food trucking, 14 years ago. Nowadays you see it everywhere, also here at the event. But then, these days they were in New York, the food truck, not in Switzerland. And so we decided to pilot the food truck. So we invested a little bit more than 100,000 to build out the food truck. And I think it was 9 months later we shut down the operations and we sold the car. So otherwise, if we had just went through the big scaling thinking, we would have 10 of these, and you can't sell 10 food trucks at a time. So we were quite glad that we just took the risk, but we mitigated it through this pilot thinking. Then you saw the picture of the Bern affiliate. Liquidity planning was at this time very important, because as I said, we spent over 1 million, and after 2 years, I mean, this was still in the books. And it was also the time when we had the bank loan, and we had to give it back, to pay it back. And so at some point, we just realized, okay, now we have to really to look where the money goes in order to be able to buy back the bank loan. And at the end, just keep it simple, everything you do. And in gastronomy, in system gastronomy, as we did it, everything should be multi-pliable. And that's, I think, the key, to have the headquarters cost at the low level and the guest revenue curve at the top. Thank you very much.
Thank you, Andy. Kannst du bleiben? May I ask you to come back on the stage? And now it's your turn. Do you have questions? You do have a micro. Just a moment. First question is here in the front row.
Thank you. Well, thanks a lot for the presentation. I have a small question. When you're talking to investors, the first thing that they ask you is, how defendable is your product? And in the case of you, I guess it's not defendable. The technology is not defendable. What is your answer?
My answer was like, be faster than the others. I think this is where we create moat. But like now Bexio is a dominating player in its market. This is also why we decided against early internationalization, because like we said, like we need to win a country before we enter in another one. I think another aspect in our case was that we offered open APIs, so that other could integrate their products to our products. And today, Bexio is integrated in so many systems, you can't just replicate that without investing a lot of money. So I think go-to-market, or mastering go-to-market, being able to grow faster than all the others creates a huge moat. Because like if you grow fast, you're able to raise more funds. If you raise more funds, you're gonna grow even faster. So one key aspect of Bexio's success was that we were really, really good in sales and marketing and faster than the others.
I would like to add to this question. Value proposition does protect you. Because when this value proposition of your offering is perceived, easily perceived, it's compelling. So customers understand the value, and you don't have to tell it in a push mode. It is something that can be sold almost on its own. So the value proposition goes very close together with ideal customer profiling that you know very well what's the either headache or what's the big value and what is the difference between the other offering. So value proposition, that's what Jeremias just said. He is visiting all customers now at the beginning of his business to understand exactly what is needed. This is your protection. Hit the need of your customer. Patents are great when it's really high-tech stuff, but in normal things like food, you can't do it also not like that. You said also trends. You have to be in the trend. It's your turn.
Yeah, we thought about actually to protect our recipes. But then we just realized if we do it, then it's open to everyone. Then there's 1 gram more salt in it, then that's the other recipes. So what we did actually to protect is we just said also, let's build up the brand as fast as it goes. And that was our protection. And so we were very well known at Hitzberger as the healthy fast food chain. And so at some point, just the people knew us and the other were the copycats.
Thank you.
Welcome.
Other questions? Over here.
Yeah, thanks very much for your presentations. Given the current situation that everybody talks around funding and the geopolitical situation, question to both of you, particularly for you with Herzberger, would you do it again?
I definitely would do it again, but probably not in that operational role again that I was then. I now have family, and so that's a personal decision actually to don't do it in that intense manner. But to do, if the question was if I would found another entrepreneurial story, then yes.
I'm doing it again.
But more specifically in what you did, how you did both of your businesses. Do you think you would do the same thing? I mean, I don't mean copy it, but would you take the same journey again now, given how things have changed since you started your businesses?
Absolutely. I think it's a great... I'm a software guy, and it's probably one of the most interesting times to build a software startup. Look what's possible with AI. So absolutely. This is also why I got back to founder mode, and I'm building my next company. Yeah.
So what I do right now is actually I'm in the board of other food-related companies, and that's probably the thing I do right now. I know that gastronomy is quite difficult to have success. As we've seen it, there are lots of other companies, well-known companies that just they don't exist anymore. So I'm happy to be involved with some of them, but not in the operation role again.
Other question?
Okay. Thanks for your insights. Could you maybe share each one thing that was an unexpected setback? I feel as an entrepreneur, there's sometimes your biggest enemy is yourself. You have a wrong assumption about something that's going to be easier or wrong or something. Is there any setbacks you guys have by maybe a wrong assumption or something you had to overcome?
I can take that. The food truck example was one of them, because I really believed in it. I said, okay, that's one thing that you see in New York, you see in the United States, and this will come over to Europe also. And I mean, you have to be aware that the rental costs of these 88 square meters at the main station Zurich are really, really huge. And so we just thought, okay, the food truck, we don't have to pay any rent because it's on private property, probably or just say 500 Swiss francs a month, and that's fine. But there are other things that showed us it will not work. And just to give the answer, or my answer to it is, the weather conditions in Switzerland are not the same than in beautiful California, or whatever it is.
I can give you maybe an example of Pixel Vision. Pixel Vision is offering the digital identity in order to onboard your telco, abo and so on, or to onboard directly an insurance policy. So at the beginning, the company has been offering to enterprise customer on-premise solutions. where you had to send people to integrate the software in their environment. Very heavy in terms of workload for your team in order to make the customer happy. Then we have been looking at different verticals. For instance, insurance, they are a little bit less sensitive in terms of security. Then we developed a cloud-based solution, a self-serving platform where you could download and access all this type of feature for digital identification. Then we have been winning another vertical in terms of the online gambling industry. Then other verticals where do you have the access through onboarding, self-automated onboarding to access your product. Then the business started to scale. So on-premise was a disaster, cash burner. All the rest afterwards starts to really pick up. So we had also to educate the market that cloud is viable and not that dangerous as they might think. With banks, it's still different on cloud-based solutions. They want to have it online. And that's one of the examples where we had to understand and change the model in order to scale it.
Jeremias?
Setbacks. I will have a session at 3:30 about my biggest mistakes and failures. So I will share a little bit more then. But I think one is like that I took product market fit for granted. Once we've hit product market fit, we were scaling. Then we decided to go into another vertical, and we completely failed because like we were sure we could just like take the same product, the same messaging, and go into that vertical, and that led to a quite hard restructuring of the company. So this was a near-death experience in the end.
Thank you. Shows that it is always a little bit bumpy road.
It is.
No.
Yes.
Please.
Yeah, thank you for the insights as well. It was great. I have a question on the service. So if you have a service, like what's the first step to make it scalable? What would you like say is the first step you would do if you have a service?
Actually, my first company was like a service model, and of course, we will never scale like a software case. But what we did, we invested heavily into like standard operating procedure, like almost if you build like a system gastronomy, because like if you don't need to reinvent all the processes for every customer's project, of course you have a higher margin. So I think this was like one big leverage.
Thank you. Also got a question. A lot of good input, thanks. And my question is like, how can you get someone to join your board or your advisory board? How would you do this as someone with an idea who wants to grow it or scale it?
So pitch it. I think in the end, everything is about sales. It's about telling the right story to the right people. If you want to win the best employees, if you want to win the best advisors, the best investors, yeah. So invest a lot in your pitch.
Thanks.
What you need it for? What you're looking for from this position?
Like getting some help or like inputs like this presentation, or someone who guides you through if you're in the growth stage and bring you to the scale stage, or just.
I think when you have a compelling story, especially when you look for boards, because it's an engagement that has duties. So this board member needs to have a kind of holy fire also in your case. You cannot just have a consultant, otherwise you buy consultancy. So your story must really highlight and also enlighten this person in order to you have to feel he is really willing to help you to get a successful market fit, and that is very important. It's identification. That's my personal thing. Without identification, having a wonderful CV, with having done so much things and having no time for you, That's not what you're looking for.
Thanks.
There's another question. And then the last one here in the front row.
Would you visit your clients in Geneva again with the present?
Yes.
And how would you create the fear of missing out in the beginning of your startup?
Right now, we have a waiting list of companies who want to use our service, but we are only able to onboard a handful right now. So this creates a certain urgency and helps. Yeah.
And the last one here in the front row.
Regarding the SaaS pricing, that you don't come from cost and calculate the margin, but you come from value creation. And most of the time also the competitors don't reveal their pricing. Can you give me from practical experience maybe 1 or 2 advice, how can you fix the pricing and not being too cheap or too expensive, especially when you're very at the beginning and you're getting to know your customers, but you need a price?
I'm exactly in that phase right now. So what I learned is like it's easier to lower your prices than to increase them. So if someone tells you it's too expensive, it's hard to, you can just like offer discounts. So what we do is like to really try to understand the value we deliver, and then we take like the highest price point. Because like it's easy to sell a cheap product, and it's hard to sell an expensive one. And we really want to do the hard stuff first before we enter into scaling. Because like lowering prices to grow faster is easy. But I really don't want to sell by price right now. So by now, I really want to have a value-based approach. And so of course, I look at the market, I look at what the customers are investing right now into their we do payroll processing in their payroll processes, and then I just have like an ROI calculator, right, where I show the clients, okay, you invest today, you have that much headcount and software cost and so on, and with our solution, you would save that much money. But still, we're not the cheapest one in the market, because like we offer superior tech and so on. But in the end, it's about being obsessed about data, because like you need to measure, and and pricing is an evolution. At Bexio, we change pricing almost every year, and still does. So,
just one small add. When you are me too or more of the same, and the price has been set in the market already by others, so you have to offer more convenience. So the customer feels he is convenient working with you because he has less work or less headache, or you solve the pain in a different way that is convenient. So that is the way you can attract your customer base easier. And then later on, you can increase when the loyalty is there with your customers, you can increase later on when convenience is perceived and churn doesn't happen. You can start to offer other values in addition. So upselling is the way where you have a lifetime value that will increase. So it's a strategy. Pricing for me is always a strategy. You need to have the customer first. It has to cover your costs. That is important. Don't make something that you even pay the customer that he's becoming a customer. It's not a good idea. US companies try to do that, but they have so much dollars they can print themselves almost. We are in Switzerland.
We are running out of time. Thank you for your interest, for your questions. If you are interested in our program, this will lead you to our website. And a warm applause for our speakers.
Thank you.